Hey guys, welcome to Business with Lo-hen, where it's all about mastering business and creating wealth. One of the viewers commented on one of my videos and asked if I can do a stock analysis on Albemarle, and that is what we're going to do today. So let's jump into it. So let's start with the income statement. For me, I really like the consistency in the gross profit. This is a good sign. And the selling and general administrative expenses are 13 to 15% over the last 3 years. This is quite good. And research and development expenses is low. This I like in a company. And then operating profit is quite high, it's 27, a little bit inconsistent, but on the higher side. And then we look at what is actually coming to us as owners of the business. It is 17, 8, and 24% respectively over the last 3 years. So it seems as if the company is profitable. This is only on the income statement though, and so we'll have to move on to the balance sheet just to see what the stance of things are. They have about $1.9 billion in current assets, but also have about 1.1 billion in current liabilities. So there's not a lot of working capital, about 800 million, give or take. And this isn't great, but what I do like is that they have a goodwill of about 21% on total assets. This for me indicates that they do acquisitions, and with acquisitions there's always a possibility for future growth, and I like this. But one thing that we should take into consideration with goodwill is that they are not overpaying for just the sake of overpaying. So this for me is something to investigate, but I do like the fact that they are purchasing companies. And then as a company's strength, they are doing quite well on total equity, return on total equity, which is 15% for the year of 2018. I would advise you that you do a little bit deeper analysis. What I mean with that is that you take this over a couple of years and see if you can see some consistencies and patterns, because if taking 1 year as I'm doing now is highly risky and leaves a lot of room for error. So I would advise you to at least look at 10 years, and this is where the work comes in, to look at least 10 years of financial statements. This includes the income statement, the balance sheet, and the cash flow, because all of them have their own messages that they are telling you. So I advise you to do that over the 10 years. Then this is where I usually start, actually, is at the cash flow. For me, the first thing I look at is the net cash provided by operating activities. As you can see, this is 2016, 2017, and 2018. What I don't like is that it isn't consistent, nor trending upwards. So this is a big concern for me. So this means that the operating part of the business isn't doing too well. So they may be perhaps gaining profits from divestitures and things like that, which isn't really good if you are an operating company. It is great if you make money through divestitures whenever you are an investment company and it's time to get your return out of your initial investment and divest that investor to get a new capital. But for a operating company, that is not really what you want. And like I previously said, I would analyze 10 years here just to ensure that I'm not missing anything, or that you are not investing in a company that is really highly unpredictable. Because no matter what, you are not Nostradamus, neither am I, and I'm not trying to predict anything. I'm trying to see if there is any probabilities that's going to line up in my favors. And here, net cash provided by operating activities, for me, if it's trending upwards and consistent, I think you can work with that company, because then your analysis becomes a lot more secure just by that fact. So this is where I usually start. This is for me a big factor, but at least they are making money, cash from operations. But like I said, I don't think that it's really, management isn't doing, or all the operations aren't fully efficient as they should be. And considering that it's currently a really good market, a bull market, for them not trending upwards is a big concern. So I would investigate that, definitely. Here you can see massive net cash provided from investing activities. Okay, and then what I like about a company is they are on too highly levered. So total assets for the company is around 3 billion. Total liabilities, my apologies. Total liabilities about 3 billion compared to about 7 billion of total assets. So that is not too highly levered. Which I like. And then now let's go into the intrinsic business value, because this is where we can kind of see if we should buy the stock. So I just calculated the future cash flow that will go to the equities. Then I used the risk-free rate of 2%. So the risk-free rate that I'm using here is the yield of the 10-year US bond. It's currently at 1.8%, so I just made it 2% for the ease of it. And then I use growth rates of 5, 7, and 11% respectively. The reason for this is because the last 5 years, this company grew at 7% annualized. And I saw forecast for the analyst forecast of 11%. So that's why I assumed 11%. But they are usually on the positive side. So the 7% for me is a little bit more accurate, since that is the rate that has been achieved over the last 5 years, and a rate of 7% annualized is a decent rate. And then I have a 5% in here. The reason I have the 5% in here is because this is for me kind of the minimum of a company that is a decent company, that a decent company should grow at. The reason for that is that the US GDP will grow at between 2 and 3%, and then add another 2% on for inflation will get you to the 5%, and that's the reason for me using it. So then, guys, I just use the future cash flow for equity, and then use that to discount it to present value with a terminal value at the end, because obviously the company is not going to stop operating at the end of year 10 and it's the end of it. So I used a terminal value in this calculation. And assuming the risk-free rate of 2%, this is the intrinsic value that I got per share. Please note that I used 2018 financial statements. So I did not use the latest quarters, and it's not up to date exactly. So you will do a better job if you go into the latest quarter as well, analyze those things. So the intrinsic value for 5% growth is $97.2, and for 7% annualized growth rate is 113, and 11% it is 153. So honestly, I do not see this company growing at 11% per year. Not when the operating cash isn't growing at a rate that it should in a bull market. It just doesn't make sense. While in a economy that has money, it just doesn't make sense for me. So I honestly don't think that 11% will be realized. This means that I think that the 7% will be realized, and even if it doesn't on the 5%, you still have on the current price, which is $75, about a $25 to $35 margin on that. So you can decide if that margin is big enough for you. But please note that this is only 2018. I've only analyzed 2018, and if you wanted to invest in this company, I would advise you to do a 10-year analysis. It will give you a lot more clarity on if this company is going to be around for the long run, what their business model is about, and what they need to do to grow, because all these things are factors that is very important. Guys, I really hope you enjoyed that. If you did, please hit a thumbs up, leave a comment if you have anything to say. I would really appreciate that. Subscribe if you haven't already. And if you never want to miss a video, please hit the notification. I'm looking forward to your feedback and doing more of these stock analysis. Let me know what your view is on this company and if there's something that I've missed. And thank you for your time, and see you soon.